Morning, everyone. Welcome to our second InvestSense video. This morning, we've got Tom Walker from Schroders talking about global property. As you know, property for us as South Africans is it's a very interesting and often personal assets that sits in our portfolios. So we often look at just our local property, but it's nice to get a broader view from a global property specialist. So that we're very fortunate to be sitting in Schroders' office in London with Tom. Tom runs the Global Cities Fund for Schroders, and we'll be chatting through some of his ideas around what the global property market looks like, and also about diversification. Maybe we can just start with what is it you look in your fund? So you speak about global cities. What is a global city? How would you define a global city, and how does that fit into your portfolio?
Yeah, so global city, we're using data to look at every city around the world, and we're looking at about over 700 cities globally. And we're saying, from an environmental perspective, are they in good locations? Is the city sustainable? We're saying, from a transport point of view, have you got good connectivity? Can you move people and goods in and out of that city quickly? We're then looking at innovation, which is world-class universities. Have you got any? Venture capital funding, are there any deals being done in your city? And then finally, it's kind of the economic strength of that location. And we're ranking all these locations around the world, and then we're sort of saying, right, these are the top 30 cities. Ideally, what we want to then do from an investment point of view is allocate as much capital as we can, assuming the valuation is there, in those top 30 cities, because that's where the economic growth will be.
And I looked at the top 30 index that you're referring to. I noticed there not a lot of emerging market cities in there, more developed world. India for me is something that is, as a country, but also the different cities within India, is something that is almost the next China or the next up and coming big emerging market. Is that, where does that sit, or how does that stack up, I suppose, in that index?
Yeah, it's an interesting point. I mean, on the fact that in that top 30, it's developed cities, basically. The reason for that is because we had to make a decision as saying, right, well, do you want to reward cities for growth, or do you want to reward them a bit for scale? And we've sort of gone on an 80-20 weighting within our data saying, right, we're going to reward scale because we think that begets more scale and more kind of jobs. If we flipped it the other way around and you had 80% growth, you'd find a lot of emerging market cities in that top 30. And so that was a decision we made because we felt that to be a global city, you've got to be quite mature, and today's scale was quite important. But your point about India is really interesting, and we agree. I mean, when you look really at kind of the cities that are urbanizing the quickest, it's China and India. China, from a kind of a regulatory risk point of view, is quite difficult to invest in. India is a lot easier. And we do actually have one Indian REIT in our portfolio. And I would expect in sort of 3 to 5 years' time, our exposure in India to be, 3, maybe 4 times what it is today. So we're watching carefully. If you can find cities that are growing really quickly, you've got to find the right company with the right structure and governance. And sometimes that's where it's difficult. But we found one in India. I think there will be more. There's another one on our hit list, but the valuation just isn't quite there. We've obviously had the Indian election recently as well. So we're absolutely looking there. And yeah, you're spot on with kind of, what happens next.
You mentioned scale. It's quite astounding. Every time I come to London, I forget. I'm reminded by the scale of London, particularly comparing back to South Africa. I know you're recently in South Africa. How does South Africa stack up, or some of the cities in South Africa? I mean, we can talk about, I suppose, Cape Town. I'm from Cape Town. How does that stack up in your
so from a South African point of view, I'm disappointed to tell you Cape Town doesn't stack up as well as Johannesburg.
Oh, really? Okay,
so Johannesburg actually kind of screens better. It's coming in at about, I think it's 165 in our ranking. There's 760 odd. Cape Town is about 360, I think. And so there's quite a difference there. But, again, neither are in the top 30. If we think about world-class universities, I think the best-ranked university in South Africa is coming in the sort of 160s. And so again, venture capital funding, there's not many VC deals being done in those cities. So I would say that, innovation is one important point where the South African cities don't screen so well. Environmental is another one, and particularly for Johannesburg, looking at the data there, water stress is something that's an issue. Transport connectivity in these cities as well. And so it just drags the scores down. And so again, this is a global competition. And so, we're comparing Joburg to Tokyo or to Sydney.
Yeah.
And then you start to see, we're really lucky as an investor because we're global. So we really can just kind of go wherever we think is the best environment for our real estate capital.
Our Joburg clients will be very happy to know that Joburg beat Cape Town at something. So thanks for that. I saw some research, I think it was on your site, but I also read an article by 2050, I think it is, 70% of the world's population will be living in bigger cities. You kind of mentioned India as an up-and-coming city, but who in your view are going to be the winners and losers in that move? Because at the moment, I think it's about 55 or so percent of
that's right.
Of the globe,
we've sort of gone over the 50% range, and you got 70% figures. You've got Oxford University talking about 90% by the end of the century. So it's a long journey. I think increasingly. And bearing in mind, one of the meetings I had this week was with a professor of decarbonisation. I think environmental is going to play an increasing role in those winners and losers. I think maybe 10 years ago, if you asked me the question, I'd be like, New York or, Sydney or Tokyo because of the innovation and the universities and the companies that are there. But the more we look at kind of how our environment's going to change over the next, 10, 20, 30 years, I think that's actually going to really dictate, where it is viable to live and have your business. And I think it sounds a bit kind of grim, but I think that will increasingly dictate the winners. And so there you're kind of looking for cities away from kind of the equator, kind of northern, southern hemisphere cities where the environment is going to be a little bit kind of cooler, effectively.
If we move over to the landscape of property, I'm always, again, bringing it back to South Africa. South Africa's property market is obviously much smaller than what you would see in London's, but globally. I'm always fascinated by the different sectors within property and the changing landscape. I mean, maybe can you sort of touch on that briefly? You've got data centers now, you've got medical, you've got various parts in this. Property is not property, I suppose. Maybe can you just explain a little bit about that, and then also what is the most exciting part of that at the moment?
Yeah. Well, if I sort of take it back to maybe when I started my career, so in your client's portfolio, and I was sort of advising pension funds and stuff when I first started, you are the first building block of your portfolio was a shopping centre. That was the most defensive asset. Then the second most defensive was offices. The third would be last mile logistics. But in offices and retail, you probably have 60, 70% of your portfolio. Then you might have 10, 15 in a distribution warehouse. Then there might be another factor, maybe a hotel, a bit of healthcare or this and that. So that was, 20 odd years ago. Today, the smallest part of our portfolio today is offices. It's about 3%. The second smallest is kind of retail. It's, sort of 7 or 8%. The largest parts are distribution warehouses, residential, and this is rental residential. So, when you're moving to a city, you can't afford to buy a flat or a house. You've got to rent. Really good income stream. So that's another part of our portfolio. So you can just see that these, what were once niche parts of the real estate market, are now mature. And they're now kind of really kind of where we want to allocate capital. But in terms of the most exciting, and again, this is another significant part of our portfolio, would be data centers. So data centers is an asset class that we first invested in about 2011, 12. I remember we did a 6-month worth of work trying to understand what it was and like kind of what the risks were, got comfortable with it. And now today it's kind of in everyone's conversation. And so you just get these new subsectors emerge that people need. And for us, we're always focused on a city. And so whatever is needed in that city, whether it's a data center or senior housing facility or, a school, we are happy to invest in it because we want to invest in an asset where it's hard to create supply of. And because people are moving to the cities, there's more demand for it and rents grow. But data centers right now is in an unbelievable place. It really is staggering.
I'm always quite amazed by, I mentioned you in our conversation, but earlier I did a property tour yesterday, and I'm always quite amazed by the active ownership of some of these REITs. They're getting involved, they understand their market, obviously, but it's, as you said, you focusing on what that city needs. It's a lot of your guys' job is to help that city get better because you're putting, I suppose, allocating capital sensibly, which is very interesting to me. It's not just top down, invest in property and kind of step back. It's
exactly.
Very interesting.
We're allocating to try and make the city better. We're trying to make the city more sustainable. But to your point about how active the REITs are, again, that's quite interesting. Like when I first started, looking at global listed companies, a lot of them were just kind of rent collectors. And it was just like, yep, thanks. I've got a 15-year lease. Now, I would say 95, 96% of the companies in our portfolio are active. We are investing in them because they're the best at running a self-storage portfolio. They're the best at managing a senior housing facility. And they know how to add the value. And they also have an operating platform like nobody else. And so that's why they can get the most kind of money out of that asset with the best margins. And that is something that you've seen as the professionalization of our sector, where you now have companies that just focus on storage, just on healthcare. And that is exactly what we want, because they are then amazing at their job, as opposed to, well, I do a bit of this and I do a bit of that. We want the experts.
Yeah, and that's, I was going to make that point. In SA, obviously a smaller market, there's limited amounts you can invest in, so REITs are investing more broadly. But here, very much like that, the business, the tour yesterday was just mainly office, 60-70% of the way the world used to look, I suppose, in what you said, but 60-70% just in office space. And then there's someone else, as you said. So it's almost like specialists within that property market. On that point, in SA, we always talk about SA Inc. assets, so the rands, bonds, property. You need a strong economy. Things move generally with how the economy moves. Within the property market globally and the different sectors, can you get diversification? So can things react differently to different types of markets, I suppose? Interest rate cycles, economic cycles.
Yeah, so we've probably got 7, maybe 8 subsectors in the portfolio, from data centers, student accommodation, distribution warehouses, and they all do react differently. They've all got different lease terms, and so we always think about the most volatile, kind of on the edge, cliff edge, kind of on the coalface of the economy, as a hotel, because you've got a 24-hour lease, right? So if there's a recession and everyone's having a terrible time tomorrow, the hotel pricing is just going to go straight down tomorrow. Similarly, if we're in a massive bull market, your night for your hotel in London tomorrow night is going to be much higher. And so that's the most volatile part of our portfolio. So therefore, we make it the smallest. You can then go to mobile phone tower companies. So we've got a company called Cellnex in our portfolio, European mobile phone tower company. And there you have leases of 15, 20 years, indexed to inflation, very kind of, stable income stream to very high quality covenants. And so you've got a massive spread there between a 24-hour lease and then a 20-year lease. And then in the middle, you're going to have distribution warehouses, residential, that might be kind of a year lease. Self-storage is maybe kind of 2 weeks or so. So there is a massive breadth there in that diversification. What's also interesting is that if we take data centers as kind of, if you think about the growth value conversation, a data center company today is trading on quite a high earnings multiple. There's a lot of rental growth to come, so the market's happy to price that. Conversely, we've got 2 shopping center companies in our portfolio, something that we've done in the last 12 months and something that we haven't done for about a decade. They're trading on very low earnings multiples. People still think they're being disrupted. We think that's kind of largely finished and the world has sort of moved on. And so within the portfolio, not only do you get diversification across subsectors, you can get it from that kind of growth value bucket across the portfolio. And then, as you say, we've got different countries and regions. So it is a pretty nice, diverse. And I think that's actually one of the reasons why people have global real estate in their portfolio, in a multi-asset portfolio, because there is that diversification.
It is very interesting because I suppose you talked about asset classes moving in a similar vein, but that's a very interesting point. Okay, just before we close, what's the next big thing, or what are you most excited about in your portfolio? It could be a sector, it could be a city. What is the most exciting thing that really excites you in your portfolio at the moment?
Yeah, so I think there's a clear winner right now, which is, and it's very boring to say it because everyone's talking about AI, but it's data centers.
Okay.
We think we are looking at a 5-year window of potentially the strongest rental growth consistently every year than we have ever seen from any subsector. And bearing in mind, we've just come out of 10 years of, short shopping centers go long distribution warehouses where you've had amazing rental growth. To say that there's someone who's going to come out and outperform that distribution warehouse is quite a statement. So we think the extra demand for data centers as a result of the large language models powering AI is going to be a game changer for a significant period of time. So that would definitely be number one. I think from a city perspective, I think a city like Boston for us is really, really exciting. And that's all to do with, back to our kind of innovation and the world-class universities. You've got MIT, you've got Harvard there, and that is the life science capital. So, you think about, the COVID drugs and kind of research into all these horrible diseases that people have and actually finding cures. it's generally kind of happening in those life science laboratories in Boston because of that intellect. And so that for us is kind of this compound growth. It's like, it's just a cluster of expertise that we think just gets stronger. So I think Boston from a city perspective is always up there as being, really interesting place to invest. And we've got life science assets in that city. So, we feel excited about that.
I heard a very interesting take on the data centers yesterday, actually. And they were saying, because you obviously need a lot of power and cooling water to cool the data centers down and the hardware. And it's now being that problem, if there's a problem in the city, is now being, it's the problem of the companies, which are these tech companies, which will have massive balance sheets. So it's actually it's a positive thing where it's not just up to the, I suppose, local municipalities or councils. It's now they're coming in and they're needing to maybe improve water supply, improve power, improve that, and you've got these big balance sheets coming in. So it's uplifting.
Yeah, it's true. You generally won't get the planning permission unless they're going to come in and do that as well. And your point about power and how difficult it is for the grid to bring in new power, immediately is why we think the rental growth will be so strong. Yeah. So we had a meeting yesterday with one of our infrastructure analysts to try and understand how quickly the grid can bring on more power. And we think, again, it's probably 5 years away. Okay. Which just means rents will grow as more demand continues in that time and the grid can't react.
Okay, great. Thanks, Tom.
Cool, thanks for having me.
Yeah, that was great. Thanks, everyone. Hope you enjoyed the video. And thank you very much.